What's up, everybody? Today, my portfolio was down $5,300. We were down about 5% on the day. Even though my portfolio was down $5,300, this week, I've actually put $6,500 into 5 stocks. And I'm gonna tell you exactly what stocks. They're stocks I've already owned in the portfolio, but I'm gonna tell you which ones. Why am I adding right now? Why am I adding when the Fed is raising rates? Jerome Powell's out there saying that they're going to continue to raise rates until inflation comes down, which will very likely cause a recession and potentially a sustained recession. Why am I buying stocks right now? Because I'm investing for 20 plus years, and the stocks I own, I want to own them for 3 years, 5 years, 10 years, hopefully 20 years if the companies continue to perform, because that's how I know to invest, and that's how I believe true fortunes are made in the stock market. I don't know what's going to happen next week. We might be in a recession next year. We might be in a longer recession than that. Who knows? What I'm going to keep trying to do is adding money every month and buying and sharing my journey right here on YouTube. And then, oh, by the way, spending time on things outside of the stock market, like keeping a job, increasing my skills, increasing my earnings, being with my family, focusing on my health. I'm not here to focus every second on the stock market and trade in and out of stocks. I want to find great companies and own them for the long term. So if you're with me on this journey, do me a favor, like this video, subscribe to the channel, and turn the notifications on. All of that stuff really helps more people find this channel. So let's get into exactly what stocks. First, I actually want to show you the all-time performance, which this portfolio was only started on February 15th of this year. We have put $103,000 in. So I'm kind of proud of that we have put $100,000 into the portfolio since February 15th. What's not so great is that we're down $11,000. We're down to $91,000. But again, this is for the long term. And I've put so much money in because I think that we're in a good time to be investing, because some of these companies' valuations have come down so much. Again, for the next 3, 5, 10 years, not the next 6 months or next year. I don't know what's going to happen in the next 6 months or next year. The first 4 buys, this was $2,499. This was today. I bought Airbnb, $856 in Airbnb, Mercado Libre, $687, Bill.com, $156, and Shopify, $791. All right, the next set, this is actually this morning. So I bought this morning and then I bought this afternoon. So I put actually $5,000 into the portfolio today. Airbnb, $1,500 Mercado Libre at $876, and $272 Shopify at $30.04 a share. And then the other purchase this week was Datadog, $1,500 of Datadog at $91.59 a share. We got about 16.3 shares. So all in all, here is the portfolio. And we're going from largest to smallest position here. We've got Snowflake at $12,447. It's showing a gain of almost $1,400. Datadog bumped that up to the second largest position. I'll talk about why in just a second. We'll do a comparison here. $8,848. We're down about $1,200 there. Rocket Lab, $8,600. This is the one I think has the most risk, but also the most potential upside. I did a video on Rocket Lab. Just check it out. $1,500. We're down $1,500. CrowdStrike's $8,500. Meta is $8,300. We're down about $1,600 there. Meta is, not going to be a super growth stock, but it's just so undervalued in my opinion that if VR, AR, the metaverse works out, has some huge potential upside over the next 5-10 years. GitLab, $7,500. The Trade Desk, $6,700. Both of those are in the green overall. Tesla somehow is in the green overall. Cloudflare, $5,400. Mongo Database, $39. Shopify, $36. Airbnb, $36. Bill.com, $36. Mercado Libre, $36. So what you notice is what I added to was my smallest positions, right? And you can see over here what the actual position size is, a percentage of the portfolio, and then the target. Right, so it's not going to sell these shares. I'm not going to sell shares to bring this down from 13.5 to 8. But what I will do is add to, and now these are all at 7. So what I'm going to be doing is adding to Cloudflare, Mongo Database, Shopify, Airbnb, Bill.com, and Mercado Libre until they get up to 7%. And my goal here is to focus my energy on doing the research and finding the best companies and not stress about, is this a 9% or a 7% position in my portfolio in terms of the amount of money that I add. If I make them all basically the same, it just removes one layer of decision making that I need to make. And if I'm right about the investments, then it doesn't really matter if I put 7% versus 8% into one. But what having them all basically the same does is it also protects me. I can't think that I love Snowflake so much, I'm going to put 14% of my portfolio into it over the long term. So it protects me from getting too big. Now, what can happen is if you are very right about a stock and it doubles or does a lot more or outperforms the rest, then it'll grow from a 7% position to a 10 or 11% position without having to add more. And if that happens, then as long as the valuation, I feel the multiple is reasonable, not completely extreme, I'll probably just leave it. If a stock becomes, more than 13, 14, 15% of the portfolio, then I would likely trim it down to 10 to 12% as the largest size position. So that lets me have space for these stocks to grow and do well and outperform, while not any of them getting to be too large of a position in the portfolio once the portfolio is a large portfolio, which when it was just starting, I didn't care if Snowflake was 15 or 18% because I knew I was adding a lot more money. Well, now every contribution doesn't make as much of a difference when it's almost a $100,000 portfolio. So that's why I'm starting to balance it out a little bit. Let's just quickly get into kind of like the why behind I like these companies that I'm adding to them. I told you because they're the smallest positions in the portfolio and I want to bring those up, right? But we're looking at fast graphs here and we're looking at sales, so price to sales ratio. This is the share price and it shows right now the price to sales ratio, the blended price to sales ratio is at 9.4, okay? With the analysts expecting 34% in growth in 2022 and 15% revenue growth per share in 2023. All right, now I've gone to a forecasting calculator on here. What this does is this takes the analyst expectations that they currently have in the system out to 2024. They're expecting 34% revenue growth in 22, 15% revenue growth in 2023, and this is revenue per share, and then 20% in 2024, and I dropped it down to 15%, 15%, 15%. This is a very basic way to kind of like do multiples and get some like rough ranges for prices, right? That's all I'm trying to do here to see if we're in the right ballpark, because these numbers are all going to be wrong, and my estimate of what the price sales ratio is going to be wrong as well. So I'm just trying to get a range here, and that's what investing is about. It's about probabilities. Like nothing is certain. I don't need an exact price target based off of a 100-line model, in my opinion, because that's a false sense of accuracy. I'm going to be wrong on a lot of those numbers, and it gives me a false sense of precision or accuracy if I think I have so many details that are all right and I come up with like this very specific price target. I just don't invest that way. So anyways, what we can do is we can see a couple different price to sales ratios, right? So if we look out to where the analysts still have, revenue growth expectations out to 2024, if we think the price to sales ratio is going to be about 10 at with about 20% revenue growth in 2024. Then we're looking at a share price at that time of $180 a share, essentially, which would be a 58% total return for a 22% annualized return. And when you look at that, on average, the S&P 500 does 8 to 10%. So if you get anything close to 22%, you're doing amazing. Right now, blended price sales is 9.4. If we want to go to sort of like a bear case scenario, and we get a blended price sales ratio, we think it's going to be about 7 in 2024. Then even with that, at that point, with that much multiple contraction, the price sales ratio going from 9.4 down to 7, you'd still get a 10.5% total return or a 4.5% annualized return, okay? Really, we don't go negative until it gets down to a price sales ratio of 6 in 2024. If they hit these numbers, if they do worse than these revenue numbers, or they do better, that's going to change things. But this is just in this scenario, right? So I feel pretty good about that level of safety. But again, I want to be a longer term investor, so let's look out to 2027. So at a price sales ratio of 10 out to 2027, based on these numbers, and I brought the growth on purpose down to 15%. They have a huge opportunity ahead of them, and I think it could be better than that, but I wanted to be conservative. Well, you're looking at 140% total rate of return through 2027 for 18% annualized. Still very, very good. And again, let's go back down to 7. So at a price sales ratio of 7 out in 2027, you're looking at a 10% annualized return. And I think growth could likely, it might dip if we go into a recession, whatever. But I think that they have a chance to do pretty sustained, high teens to mid 20s revenue growth over more years than just through 27 because of the size of the market that they're in and the expansion that they can do. So I feel pretty good about Airbnb. All right, I'll try to speed this up a little bit. Build.com, second one I added to. You might be wondering, Airbnb is pretty common. Everybody knows what they do, right? Rentals, essentially, and basically kind of disrupting hotels and stuff like that. I think they can coexist, but I think they're also going to get into actually other types of events and maybe even like other travel stuff in the future. They have so much optionality with the software business that they have. But anyways, Bill.com, a lot of people might not be familiar. So they serve small and mid-sized businesses, really. A lot of companies in accounting firms, hospitality, nonprofits, healthcare, professional services. And what they do essentially is they just help with payroll type stuff and back office type stuff. So accounts payable, approve, pay, and sync bill payments, accounts receivable, you can send invoices and get paid faster. I do some freelance stuff, consulting stuff. I use Bill.com. A lot of companies I've worked with do Bill.com for invoicing. I can send invoices that way. It's just super easy. Credit and expense management, and they're just getting into all kinds of different markets. And they acquired Divvy as well, which is a corporate like credit card company. So anyways, it's a massive, massive market. It's fragmented. Most small businesses are still operating on like legacy platforms with very manual processes. And so it's an uphill battle, but there is a huge market, especially internationally as well. Anyways, analysts are expecting 46% revenue growth, 33%, and then 25%. I put in 18, 18, and 18. And so let's just do the same thing, right? I mean, this thing is trading at a blended price sales ratio of 18, which is way down from 80. Just ridiculous, right? And again, I wasn't immune to all this. I made mistakes owning growth companies through here too, right? So I'm not criticizing anybody for doing that, but just saying how ridiculous that was, right? And a lesson learned for me and everybody else. So I'm not going to make that mistake again. But we're at a different time now. Things are just so much cheaper now, and there's still a lot of growth ahead. Maybe stock's still going to get cut in half. Who knows? But if it does, then I'll be buying more as long as I can. So anyways, let's get to these scenarios, right? Let me, Austin, stop talking. I'm having a little beverage here and just relaxing a little bit, so I'm kind of enjoying this anyways. Hope you're enjoying this too. Anyways, if we think that by 2025, this thing's going to trade down to a price sales ratio of 10 and hit these analyst growth expectations, which, again, I think are in line or conservative. I think that they'll end up doing better than this, but we'll see. That's just my opinion. You're looking at a total rate of return of 19% and an annualized rate of return of 6.4%. Okay, let's say they sustain that growth. They get down to 18% growth over the next few years. Then price sales ratio of 10 out to 2028. You're looking at an annualized rate of return of 12% or 95%. And I'm fine with that. And I think there's so much revenue growth ahead that eventually, even if the price sales multiple comes down, the revenue growth is going to be there and it's going to power the stock higher, and we're going to do just fine. And this one is, for me, hopefully like a decade plus investment, right? They have so much growth ahead. If they are growing at 25, 26% out in 2025, I think it's foreseeable it could trade at something like a price sales ratio of 12. In general, a rule of thumb is like, as long as the revenue growth is double the trailing price sales ratio, then it's in a range of like fairly valued, right? So what I'm saying is that I don't know that it's going to be there. I just think it's not unreasonable for it to be somewhere in that range if they have that type of growth, okay? And so at a price sales ratio of 12, then you're looking at a 43% total return for about 14% annualized, which is great. I'd be totally happy with that. All right, Datadog. A lot of you probably know what Datadog does, but some people might not. Essentially, they do observability, and they let companies monitor all of the applications and systems essentially that they have running to see if there's any incidents going on or any outages or anything like that, anything weird going on with their systems that they need to respond to. Because the more digital that businesses are, the more things that could be going wrong with a number of things, hardware, software, all kinds of stuff. So this lets them essentially just monitor the health of their digital business. So they have what's called infrastructure. They have infrastructure monitoring, network performance monitoring, network device monitoring, application performance monitoring. If you look down to the platform capabilities, they have dashboards. They have something called Watchdog. You can get alerts, incident management integrations. They're introducing security and log management. So basically everything a company could need to just monitor the health and ensure the health of all of their applications anywhere in the world. All right, so we've got Datadog at a price sales ratio of 19, down from 60 back in November. Man, what a year it's been, huh? And so again, we've got these analyst expectations in here: 54%, 35%, 35%. Then I put in 25% for the next few years. I think they can grow revenue that fast for a while, I think. If we look out, again, 35% revenue growth here. If we look out at a price sales ratio of about 15 in 2024, you're looking at a 57% annualized return for 22% total return, right? Let's drop that thing down to price sales ratio of 10. If it gets cut that bad, down from 19 today, and they hit these growth numbers, then we're just barely positive here. We got a 5% total return for 2% annualized. So, this stock could drop. It could see some multiple compression, and they still have to execute and hit these revenue growth numbers. But I do think there's a long-term opportunity here. So even if things don't go well here, if the company continues to do well, trades at a price sales ratio of 10 out in 2027, you're looking at a 105% return, which is about 15% annualized. Even down to 8, you're still looking at almost like 9.8% annualized. Down to 7, you're at about 7%. So even right there, down to a pretty low price sales ratio for a company the quality of Datadog that would potentially still be growing that much. You've got some decent opportunity here, in my opinion, for the long term. And they could beat these numbers, they could miss them, who knows. But anyways, you're looking at still S&P 500 type returns here with more than a 50% reduction in price to sales multiple. All right, Mercado Libre is trading at almost the lowest price to sales ratio it's ever traded at. And price to sales isn't necessarily the best metric to measure Mercado Libre off of. Some people argue it's not the best metric to measure any stock. But something like price to gross profit, or looking at gross merchandise value sold on the platform, those are different ways to look at e-commerce stocks, but we can use price sales as reference. It's low. It's at 4.43. And analysts are expecting 48% growth, 25, 26, and I put in 18. E-commerce could get really hurt in a downturn. So, who knows what's going to happen with these numbers. But the thing about it is that the stock is just so cheap historically, and just on a relative basis compared to other e-commerce stocks. I mean, it's just tremendously cheap. Now, there's a lot going on in Latin America. Inflation, corruption, all kinds of things. So definitely something to be mindful of. And that's why it's not a huge position in my portfolio. But this company is a proven winner. I'll show you the performance over time in just a minute. Even with it being down so much, it's trading so cheap now that I think a lot of the risk is kind of baked in at this point. So anyways, we're at a price sales ratio of 4 right now. And this is only, they're expecting 48%, 25, 26. So only going up to 5. Price sales ratio of 5. You're looking at a 97% total return for 35% annualized out to 2024. Even if it goes down to 3, which is almost a 50% reduction from here, you're still looking at a 7.6% annualized return. Basically doing as well as the S&P 500 for 18% annualized. And then out to 2027, if it trades at 3.5, you're looking at 17% annualized return. If it trades up at 5, you're looking at 25% annualized for 223%. I mean, in my opinion, this is the time to be investing if we can, right? These are great opportunities. Just my opinion, I 100% could be wrong. Shopify's another one. It's taken a lot of heat. And so this one's, in my opinion, has a ton of growth ahead too. But we got the analyst expectations here, 19%, 24, 26, and then I put in 12%. So trading down to a price sales ratio of 7. So let's see, out to 2024, this thing trades down to price sales ratio of 6. You're looking at 17% annualized return for 42% total return. Trades down to 4.8. You're still looking at 6% annualized. And then out to 2027, if it hits these 12% numbers, price sales ratio of 6, you're looking at 100% return over 5 years for 14% annualized. So look, we were in a place where stocks just got crushed. They got way overvalued, and now they've been crushed. Now we're in a rough stretch economically. People are predicting the end of everything, essentially. And I just think that we're in a normal, hard economic pullback, which is a part of a normal economic cycle. It's unfortunate. People are going to get hurt. Jobs are going to get lost. But these things happen, and so far we've recovered from them, right? Even if you look at Shopify, with it down, it's down like 80% from its highs. Since 2015, it's still up 37% a year. It would have turned $10,000 into over $100,000. And I was talking about Melly, right? If we look at Mercado Libre, since 2007, which was before the great financial crisis, right? Before the great financial crisis, still has returned 25% compound annual growth rate, turning $10,000 into $317,000, which is just amazing. And that's even with the stock being down, I don't know, 40, 50%, whatever it's down. So anyways, if you can find the right stocks, buy them at the right prices, and the businesses perform, you have an opportunity to have life-changing returns. And that's what I'm trying to do. I'm not recommending this to anybody. I'm just sharing what I'm doing. If you like this stuff and you want to support me, this stuff is all down in the description. It's linked to this. This is my email newsletter. It is completely free. I just made everything free for everybody. I share research and my portfolio here. And then Savvy Trader, which you can subscribe to, also for free. You can see my portfolio. You can compare it to the S&P 500, the Dow, the Russell, and if you subscribe to other people's portfolios, you can compare us against each other too, which is pretty cool. But you can also subscribe to get email and SMS updates anytime I make a trade in there, okay? So I share my brokerage screenshots and screen share on this YouTube channel just to be transparent and show you that's the actual brokerage. This is a portfolio that I put in what I buy and sell, but it does send out alerts as soon as I do that. So anyways, thanks for being here. Try to stay positive, try to focus on things outside of the market, and have your investing process be something that complements your life, doesn't consume it, and just stay positive and be nice to people out there.